Well, after 4 years of talking about it, Shell has finally sold down most of its stake in Woodside, taking it from 23% to around 4%. I'm joined by Stephen Bartholomew for Business Spectator. Steve, how does this deal work?
There are basically two components to it. One's an institutional placement at 9.5% of Woodside, a bit over $3 billion of cash for Shell out of that side. The other is another 9.5%. This time Woodside will buy back those shares at a lower price, but there's franking credits attached, so it's just under $3 billion again to Shell. So they'll walk away with $6.1 billion by selling almost all of their shares. They'll have 4.5% left.
Right, and so what does that mean for shareholders in Woodside?
Directly, not that much, except obviously the buyback component shrinks the capital base, so it'll leverage their performance statistics, put a little bit more debt in the balance sheet, which is not a bad thing for Woodside because they're terribly undergeared. More importantly, since 2000, when Peter Costello blocked Shell's bid for Woodside, which is at $10 a share incidentally, so about a third, less than a third of today's price, when he blocked that bid, Shell's shareholding represented a major overhang. They sold 10% of Woodside back in 2010, and so that was the start of this process of exiting. But 23% of the capital as a sell, it obviously is going to have an impact on your share price and depress your share price. So Woodside itself has said a number of times it would prefer to see Shell off the register, and it's become clear in recent times. Shell had a change of CEO at the start of this year, 1st of January, and his brief is to cut costs, get rid of lower returning assets and invest more aggressively in developing resources. And so there's a huge investment going into sort of the upstream part of Shell's business, huge disinvestment occurring in the downstream part, and clearly this shareholding, Shell will be looking at it over in London and the Netherlands saying, what are we doing with this? There's $6 billion tied up in this, in fact more than six, tied up in a passive shareholding. Let's get rid of it, and he has.
So the overhang that you talked about, though, there is still that there because there's still that 4% stake that Shell holds on Woodside.
It's four and a bit, so yes, there is a bit of an overhang, but not one the market couldn't digest overnight. So there's a big difference between having 23% and having 4.5%.
So having Shell off their register, does that mean that Woodside is more vulnerable to a takeover?
In theory, yes. There aren't that many people who could acquire it. I mean, it's a very large organisation. And people who wanted to take it over could have gone to Shell and said, will you sell us 19.9% of your shares? And they haven't. So yeah, it's possible. There's been a lot of talk over the years about a Santos-Woodside merger, which would be quite an interesting beast. But that'd be a merger rather than a takeover, given the scale. I think more significantly, it ought to lift Woodside's share price relative to whatever it might have been otherwise. And just give them more sort of financial flexibility to do things.
Now, what would they do with that financial flexibility?
Like last year, they paid because they've got too much cash flowing. They paid a $500 million special dividend. This takes some of the pressure off the need to try and find ways to put some leverage into the balance sheet to give shareholders some sort of souped up return. There's no doubt they'll keep looking for growth. At the moment, there's a break in their growth pipeline. Once they completed Pluto, that's where the cash started really pouring, and the next step was going to be Browse. And then after being pushed into exploring an onshore processing plant by the West Australian government, they discovered that was going to cost $80 billion at least. And so that's been deferred while they explore Shell's floating LNG technology to see whether that would produce a lower cost development. So Browse has now been pushed out a bit, so it's not the next growth plank. They went over to Israel and they had a tentative deal to buy into the Leviathan project, an LNG project off Israel. Unfortunately for them, both the sort of scale of the project shrunk and the price of the project that the Israelis wanted went up, and they walked away from that just quite recently. So there's nothing obvious for them to do with all this cash today. However, Peter Coleman, who runs Woodside, has said that it'll be a combination of trying to find ways to reward shareholders better. At the moment, they've got an 80% dividend payout policy, so that's one way of rewarding shareholders, and also looking for growth options, which might include acquisitions.
Given that Shell is pushed into more and more exploration, looking for new sources of oil and gas, I mean, would Woodside not take a similar strategy?
Woodside's been aggressively looking, both offshore Western Australia, but also internationally for growth options. In fact, ever since the Shell bid was blocked in 2000, because before then, because Shell effectively had control of Woodside, Woodside was constrained in what it could do. It couldn't compete with Shell. After 2000, they felt a little bit more comfortable about doing things in Shell's backyards, so they went into the States and have done a few other bits and pieces. So yes, I think they'll continue to look for new resources, both in the sort of the Australian geography, but also offshore.
Stephen Bartholomew, thank you very much.
Thanks, Jackson.